for more on the markets, let's bring in Barry Knapp. He's managing partner and director of research at Ironsides Macroeconomics. And Barry, let's jump off on Mike's question. Is this a year that the U.S. should be overweighted once again?
Yes. I actually took this question on the second of my three outlook reports, the one that really I try and look forward through the whole business cycle. And I still think there's a very strong case for being overweight the U.S., in particular relative to what I call the mercantilists or the export-dependent economies. Wilf just noted that the U.S. has done much better than Asia. And in a lot of ways, you set the interview with me up really nicely with having an interview with Catherine Thompson a little bit earlier, who I have a great deal of respect for, when she talked about just-in-case inventory management as opposed to just-in-time inventory management. This is a theme I've been on since the mid-2010s, this idea that we had already exploited global supply chains, cheap labor in Asia. All of that stuff had gone way too far, that we were going to need to restructure global supply chains. And if you think about the outlook as a consequence of that, we're going to be rebuilding the capital stock in the U.S., means stronger capital investment. The mix of growth moving away from consumption towards investment is really good news for corporate profits, margins, productivity. And so I think this theme is going to be pervasive. Now, to Wilf's point, to some extent, I would expect the first mover of the big export-dependent economies likely to be Germany. In particular, getting Merkel out of there would set them up for starting to restructure their economy like they did in the early 2000s to take advantage of the globalization boom. Now I think they'll move back the other way. But Asia is showing no signs of moving away from this mercantilist economic model. And as a consequence, I think those markets are going to lag badly, and the U.S. is just in a much better position. So, yeah, I think the U.S. is in a position to outperform again.
Barry, have we learned our lesson about this just-in-time inventory stuff? Because we push things to extremes, found out it didn't work all that well, but I think a lot of companies have just been kind of tap dancing their way through this. You think we have learned our lesson, and from now on we're going to change our ways?
There was a pretty good economic case to that the economics had largely been, had been mitigated just through economic forces all the way back in 2012. And in 2011, there were two big supply chain shocks. There was the Great East Japan earthquake and tsunami that shut down the auto industry for 3 months or so. Then there was floods in Thailand that shut down electronics and semiconductors. We had the Trump trade war and then the pandemic. And the longer that the pandemic goes on and the more that Asia focuses on these zero COVID policies and creates more inflation, more supply chain disruption, the stronger the case gets. So I think we've learned our lesson. I mean, you've heard it from the former Honeywell chairman. I can remember at Davos a couple of years ago telling you we've gone to a locally sourced model. So I think that will be pervasive even in the technology sector where the margins are fat. I think they'll start moving away from that. And that'll really start to gain momentum in the 2020s. But, it's been my view for some time. And this pandemic was just such a shock. I can't see how companies would still continue to rely on China for their manufacturing base.